What you have learned at university about finance is completely wrong. I actually have a master's in finance from Hong Kong, and I can tell you what's being taught there is absolute garbage. Take, for example, the idea of efficient markets, that the price of an asset reflects already all publicly known information. I don't think that's right. Because obviously not every market participant knows everything about every asset in all the detail. This is impossible. And as such, there is mispricing happening. For example, here on the blockchain, right? All the blockchain transactions are 100% transparent, but who's actually using that data? Very few people are. If you start your investing journey with the idea that there's nothing to be gained because there's already all that competition and there's all this efficiency in the market, then you cannot win, because it's all about learning more than the market. It's about gaining that information edge that's just at the border of insider trading, but it's not yet insider trading. So let's say there are rumors about company A buying company B, and you can't know it, right? You're not in the management, you can't do this insider trading. What you could do, for example, is you could look at the flight paths. A lot of large companies have private jets, and when you've got a private jet, you have to log this publicly. You can actually see what kind of jet is flying where. So you could do your research, you could try to find out, is maybe that company always flying to this small town where the competitor is located, where they don't have own production facilities. Maybe when there's recently a lot of flying to this particular town, maybe an M&A transaction might happen. You don't know it, you don't have insider information, you're simply just using the public information a bit better than the rest. Another stupid example in the academics of finance: diversification, Markowitz, efficiency frontier. I'm not sure if you ever heard about this, but the idea is that you combine several assets, that you combine them in a way that the volatility is canceling each other out, and that in the end your portfolio volatility won't be as high as if you simply just put everything in a single asset. Thus, the risk measured in volatility gets into better relationship with your expected return because you cancel out some of that risk. The problem is, what is your expected return? What do the academics normally do? They simply just use the past returns. Okay, whatever it returned in the past, it's probably going to return in the future, which is completely nonsensical. Because, for example, for Bitcoin, right, when it 100x'd in the last years, is it going to 100x again when it's now trillions in market cap? Probably not. The same is true for this canceling out of that risk when you combine in a portfolio, right? Who tells you that the correlation that happened in the past is going to stay the same in the future? For example, with Bitcoin versus stocks, right? There's very little correlation right now. But what do you think will happen if the Bitcoin ETF gets approved, all this traditional money enters the market, and then those fund managers simply allocate to Bitcoin in the same way they now allocate to tech stocks, right? They simply say, this is a risk on asset, and I onboard and offload as I see currently the macro environment. Suddenly, you've got way more correlation between risk on stocks and Bitcoin. I do expect with the Bitcoin ETF approval that correlation will go up and that Bitcoin will become a much worse portfolio diversifier. Those mental frameworks very much divert from what's really important. What's really important is to gain a market edge, to learn more than the average, to have more skills, to find out where those planes are going. If you diversify, don't hyper focus on correlation. When you diversify, simply just work with the assumption that not every bet that you're making is going to play out, so you don't bet 100% of your portfolio on one thing. That being said though, diversification is nothing else but an insurance against the unknowns. The more you learn, the less risk there is. There is no such thing as a fixed risk to reward ratio. Academics always say high risk means high return, low risk means low return, as if there was any kind of linear connection between the two. It's not true. What's actually true is that the risk is very, very different for different investors. If you're simply just spraying and praying and you buy 100 different companies, or you buy an ETF on the entire index, of course your risk isn't low. Your risk for every individual asset is actually as high as it could ever be, because you can't be informed about 100 companies. If you want to maximize risk to reward, you don't spread yourself across 1,000 assets to cancel out some correlation. What you do instead is You buy 5, maybe 10 assets that you can follow very, very closely, and you study the heck out of them. If you buy individual stocks, not a single earnings report should be a surprise to you, because you should understand the mechanics of the business enough that you already know what the profit and loss is probably going to be. There's a reason why academics become academics and why the people that make money actually make money. They figured out what really matters. Warren Buffett didn't start out buying 50 different companies and diversifying. He bought very few companies in a market that at the time was very inefficient. The stock market at the time was very inefficient, and I believe he went into the library to get all this data that most other people weren't looking at. Nowadays, I think that inefficient market is crypto. Your long-term outperformance, besides the luck, comes 100% from being better informed than the rest. You can only say something is cheap or something is expensive if you can estimate what the underlying value is better than the others. When you're trying to make your money in the stock market, or when you're trying to make your money in the currency market, you've got a harder game because you're competing with the hardcore quants, the Einsteins of this world. If you get into crypto, you're gambling against degens. What do you think is easier, timing the tops and bottoms against people that have no idea what they're doing, or doing the same thing against the hardcore quants of this world? If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. Inform yourself better than the rest. Join our free Telegram. Link is down below.